Insurance agents from around the world, welcome to the Insurance Guys podcast. My name is Scott Howell, your fearless host and leader, insurance agency owner and insurance evangelist for I Protect Insurance and Financial Services, based out of Huntsville, Alabama. And before we get started on today's episode, please help me welcome. He is a 6'3" sophomore from Mobile, Alabama. Parade first team All-American, Rivals 5-star recruit. He is a fantastic insurance agent and a great American. Ladies and gentlemen, please put your hands together and welcome the incomparable Mr. Bradley Flowers. How are you, Bradley?
I'm great, Scott. How are you?
Man, you look good in that light. You almost have like a saintly look about you. Like, I don't know. You just look, you look really, really good right there. I'm telling you,
I got
man.
Botox.
Oh, you should get Botox.
I definitely did not get Botox.
Bradley, I got a story, then we're going to get on with our guest today.
Okay. Back
afternoon, I take a walk on our property, down the back side of our property with my wife. We're looking for arrowheads back there on our back near the bluff. And she gets a phone call. And my neighbor across the street, Mr. Shane Gillian, shout out Shane Gillian, calls her and he said, "Hey, I'm just letting you know there's a guy passed out in the ditch at your house by your mailbox." So she hangs up the phone. She tells me, she says, "Scott, we got to go back up to the house." So we start walking back to the house. I said, "Well, we got to go back to the house for?" She said, "There's some guy passed out in front of our house." We get up there, Bradley. This dude, the only thing I could figure, he must have been on black car.
Is this the guy on the four-wheeler?
No, that was another story. That was the next day. This dude is up. He must have been on black tar heroin because he wasn't like tweaking like a meth head. He was swaying. He might have been drunk. I don't know. But she walked in the house and called a friend of ours whose brother's a sheriff's deputy up there. And in 5 minutes, that dude was in the back of a squad car going to Morgan County Jail. Next day, I'm at the front of the house. I'm doing something out in our garage, and this guy comes up into my driveway. "Hey, I just wrecked my four-wheeler. You mind if could you pull me out with that Kawasaki Mule?" I said, "Okay." So I go down there, and this son of a gun.
Did you know this guy?
I have no clue who he is. Brian Chambliss is all I know. Said he's from Union Grove. Let me tell you why he ran off into the swamp beside my house. Because he had stolen, I'm sure, a full-sized car tire and was trying to hold it on the back of the four-wheeler while he's driving the four-wheeler. And once
you need both hands to drive a four-wheeler.
You do. It'd be a good idea. Well, he's driving down the road, and when the four-wheeler gets a little squirrely with him, because he's trying to hold a full-size car tire that he just stole, he goes off in the ditch, and when he does, he goes down in the swamp and buries that thing all the way up to nearly the seat. And I had to get him out with that.
Tell everybody what you told him.
I walked up 3 feet away from him, pulled my phone out, and I was from here to that television, snapped a picture of him on that four-wheeler.
And he's going like this in the picture.
He's going, and I said, "If I find out you stole that four-wheeler, I'm going to cut your damn head off." And he cranked it. And he took off going the other direction. But right before he turned around to go, he goes, "God bless you, sir." Last thing he said as he drove off.
I was actually thinking about this. I was thinking about the community that you live in this weekend.
It's Meth Mountain.
You know Justin Danger Nunley on TikTok? Yeah, that's listen, did you know that guy?
Yeah.
He posted he lives in
South Alabama.
He lives in Eglin, in Florida. Not too far from here.
Oh, I thought he lived in South Alabama.
He's an Alabama fan, but no, he lives just north of Destin.
Okay.
He posted a video on TikTok yesterday, basically saying, "Hey, don't come to my house," like because fans will just show up to his house. Yeah. And I said, Scott has, not that we have near the following he has, but Scott has given his address on the podcast before. And I was like, I wonder, because I wouldn't like a podcast listener stopping by my house. And I was like, why does, and it hit me. I was like, wait a minute. If somebody tries to come to your house, the chances of them getting murdered before they get there are very, very, very high. If they don't get murdered, the chances, I would imagine the chances of running off the road into a ravine never to be seen again are pretty high. So you've limited your, maybe that's why some of our downloads have dropped. I'm kidding. Our downloads haven't dropped.
So the problem you got getting to my house is when you start driving, I told you the other day, getting off the interstate, come to my house, you got about 30 minutes that you are in, you might as well be on the moon. Yeah. And I think most people that would try to get to my house after about 10 minutes would be like, oh, hell no, I'm not doing this. This is, I don't know where I'm at right now, but I know I don't need to be here. This is not good. I don't think many folks have the gonads to try to get over to my place. Interpol can't find you at my house. I'm telling you right now, it's a lot. But guys, we've got a very special podcast guest on today, and he's somebody that I am wildly interested to talk to. And if you want to talk about a resume of success, last week on the podcast, I said, if you want to make a little bit of money in the insurance business, sell personal lines. If you want to make a lot of money in the insurance business, figure out how to sell mid-market. If you want to make Oprah Winfrey money, have your own Bell helicopter and be, buying an island down in the Bahamas somewhere and 6 houses all over the world, figure out how to do what this man's done, which is, build programs, start an MGA, start all this reinsurance, all the things he's done. He's the guy that has figured out the Rubik's Cube of how to make a bunch of money in the insurance business. So without further ado, I want to give him the introduction he's always deserved. He was born, raised, and lives in Clinton, Tennessee. He is married to the beautiful Karen. They have one son who's 28 years old. And this man, all he's ever known for the last, I don't know how many years, is insurance. I want everybody to listen to this resume here. 1983, he starts Madison Insurance Group, regional retail agency with locations in the Southeast. And then in 1998, he forms Appalachian Underwriters, owned by himself and his brother, and they sold to Acrisure in 2001. Now, I know he's been with Acrisure up until December of this year when he actually left and retired from Acrisure. He's also formed Accident Insurance Company in 2003. He's formed Invo PEO in 2010. 2008, he formed Appalachian Reinsurance, Class 3 Bermuda-based reinsurance-focused program business owned by himself and his brother. 2009, he formed American Builders Mutual Insurance Company. 2022, he's formed Cajun Underwriters Reciprocal Exchange in partnership with Safe Point Holdings. It's an admitted homeowner company based in Louisiana or focused on Louisiana homeowners. In 2023, he merged Cure with Safe Point Insurance Company and formed an additional Florida-focused reciprocal called Manatee Insurance Reciprocal Exchange. In 2024, he formed Hollers Insurance Company, RRG. They specialize for short-haul trucking in the Southeast, also owned by he and his brother. Ladies and gentlemen, it is my profound honor today. Now, that's resume of success right there, brother. He's done it. He's done the damn thing. Ladies and gentlemen, it is my profound honor today to introduce to you first-time guest on the IGP, Mr. Bob Arowood. How are you, Bob?
Hey, man, I appreciate the intro. Appreciate what you guys do. Scott Bradley both. Glad to be on the podcast. I got to let you know, I've been listening to y'all's podcast for 5 or 6 years. I got 2 beagles. so that's my, when I'm walking my beagles.
Yes, sir.
Then that's podcast time. That's podcast
it.
time.
That's right.
Yeah, so you guys are on my list. I really appreciate what you guys do for the retail agency force. And you guys have relevant information to help folks build the best business you can be in right now as a retail insurance agency. You don't have a lot of folks do that. Everybody's trying to make a quick buck for themselves. What I really like about you guys with your podcast, you're trying to help the agents, build up a lifestyle business. That's hard to do.
That's exactly right. Bob, I've got so many questions for you. I just rolled off, and I had to do it quickly, all of the different types of insurance-related businesses that you have been involved in. I want to ask you a question that nobody maybe's ever asked you. I don't know. But you talking about 1983 to 2024 has been a pretty good little minute there.
Good run.
Which one of these businesses that I just named off, and there's a few others on here as well, has brought you the most enjoyment and the most satisfaction and monetarily been the most productive for you and your family?
Well, of course, money ties into happiness too. So, which ones do you make the most money?
Yep, that's right.
And that's, but I've got a buddy. He had an insurance case. It's been 20 years ago. He set up an insurance company. He started out as a retail agency and said, "Man, I just want to be a retail agency, and that's what I'm going to do." And they said, "Okay, next phase, I really want to be in a niche in retail agency." That's what I did. And next, I'm going to set up a wholesaler. Okay, that's what I did. Next, I want to set up an MGA, and that's what he did. And finally said, "I'm going to set up an insurance company." That's what he did. And they said, now I go back at night saying, "Man, I wish I just stuck to them retail insurance agency, because it's a simpler business." But there's no,
and not as much risk. Not as much risk.
Yeah, you're right. But it's just, I like everything to do about insurance. So it's all I've ever done, and I just enjoy it. To do other things, you need to be naturally curious, and you need to enjoy what you do. If you're, I've got buddies, they do insurance. That's a sideline. The main passion is NASCAR race car, or bass fishing, or golfing, or whatever. And hey, I get it. I just don't have any hobbies. I mean, it's what I've always liked to do. I've always been partners with my brother Bill, and we've always had the same vision growing up, and that's just. If you enjoy what you do, if you look forward to get up in the morning, it's a good thing. If by Sunday morning, Sunday night, you said, "Man, I'm looking forward to Monday," you're in the right career. If you're not, do something else.
Yeah.
Just do something else, because you won't be successful. You're successful on what you enjoy doing. And guess what? If you're successful, enjoy it, you make money.
Yeah,
that's exactly
But nobody that does stuff they don't enjoy that makes a buck. I don't know anybody that does that. It's just, those two don't go together.
So before we came on the air, so our reason for having this podcast, one, I knew you were a listener. But I got a text like a year and a half ago. "Hey, Bradley, this is Bob Arowood, CEO of Appalachian Underwriters, who we have some business with. Give me a call." Or I was like, "What in the world does the CEO of Appalachian Underwriters want with me?"
Sure, right.
And we had a great conversation.
Sure.
And before we got on the air, Bob mentioned, okay, take us through what's the difference between MGA, wholesaler, program administrator. Obviously, most people know Lloyd's cover holder. Talk about the new, a lot of times those four get thrown in the same bucket.
They do.
And they are very similar. There's a lot of cross-pollination there. A lot of the function is somewhat simple. But what are the nuanced differences between those four?
Yeah, and I think a lot of folks just have different terminology. So I'll tell the world as I see it. Okay. So obviously everything somebody's got to start something. So that's where the retail agent comes in. So somebody's got to make a sale. The world starts at that. So that's that's the biggest space you got. And like you mentioned before, you can be a retail agent that specializes in certain niches, which, some agencies, they say that's the way to go. Some folks say, "No, I'm even more generalist." Okay, you can debate that all day long. And then you can have, okay, well, either one, I've got a great agency network following, or have a specialty. So, I want to set up a wholesaler to kind of, because I work with RPS or Amwins, or pick a big name and say, "Hey, your service ain't worth a shit." And, I want to be able to work with folks I know is going to give service on a special product, or could be geographic region. So maybe it's just in Alabama, or generalist, but we don't work with agents in Alabama. From the wholesale side, you're middleman broker, so you don't have direct contact with insured. That your customer is that retail agency.
Yeah.
Always keep that in mind. If you ever work with a wholesaler and they try to bypass you, run, because they don't know who their freaking customer is. It's a retail agent. So so wholesale, all you're doing is wholesale brokering between the retail agent and a carrier. And so that means you got no binding authority. You got no authority to bind business. You've got no, authority to endorse policies. You're just being that middleman broker. Now, the first thing you're going to say, well, why would a carrier work with a wholesaler? Because it's frictional costs. You think about it, because the wholesaler's going to get more commission than the retail agencies. A lot of carriers figure it out. Say, look, I don't want to deal with 10,000 agencies. I'm going to deal with a wholesaler and let them deal with the masses. they'll understand the type what type of business I want to see, and so that reduces their frictional costs.
Right.
So it's a good deal for everybody. So that's wholesale. Then you go up to next is the MGA, managing general agency. Okay, so the difference is you've got authority, but it's authority set by the carrier. So let's say somebody like I don't pick something Scottsdale. I don't pick a carrier.
Yeah.
Hadn't heard that
let's
name
say
in a while.
Scottsdale works with, let's say, 120 MGAs. They all have the same product, same pricing, but you have authority to buy in business, and you have some pricing authority. Now it's not a lot, usually 10 to 15 points up and down. It's not like crazy pricing, but you have some wiggle room on pricing. But you have to underwrite the policy. You have to do loss control. Sometimes you got to do the billing, and you get paid more commission for that. So you got retail commission, wholesale commission, MJ commission. But with the MJ, there's more responsibilities. So your butt's going to have an underwriting audit every quarter by the carrier to make sure you're following all the guidelines you're supposed to follow. So so that you can be a generalist MGA or you can be a specialist MGA. Just like you can be a generalist wholesaler or you can be a specialist. Whatever you want to do, it could be specialized on product, or it could be specialized on territorial. I like this is just Alabama, so I'm going to do the Alabama, or I only want to insure daycares. Okay, but I'm going to have a wider footprint, so that's fine. Next level, what I call MGU, a managing general underwriter. That's folks that have broader authority, and they usually distribute their products through other MGA or wholesalers. So let's say I'm something like Tokyo, Swiss Re. They say, look, I'm going to give a capacity. I don't want to hire an underwriter. I'm going to give capacity to an underwriter that I trust, and we're going to let those underwriters do our company functions. Meaning they got the full pen, pricing, you name it. A lot of times claims, sometimes even placing the reinsurance. And their customer base is usually wholesalers, because they don't want to deal with the 20,000 retail agencies.
Right.
The MGUs usually have deep expertise, D&O, E&O, property cat. If you look at some of the publicly traded brokers like Ryan Specialty, they do wholesale, they do MGA, and they do program administrators. They do all the three buckets. Usually a program administrator also has some type of loss sensitive commission structure. If you're a wholesaler, you get commission, you put a fee on and state you can, you go on with it. MGA, you get a commission, you can put a fee on and state you can. There's usually a profit sharing component, just like we're used to on the retail side. Now the MGU, or we'll talk about program administrator in a second, usually there's some commission at risk. Meaning it's not a profit share. It means if your losses don't make a buck, you're going to lose some money. If you'll make some money, you're going to make some more money. So you got to eat what you kill. And we can talk some mechanism of how you do that. Could be as simple as a swing commission. Say we estimate loss ratio to be, I make up a number, 55%. So if it goes to 60, we're going to take away 5 points of your commission. But if you're 50, we won't give you 5 points back. So you got we heard everybody talk about skin of the game. You got skin of the games. So that's an MGU or a program administrator. So let's talk about the next level's program. Usually program administrators is usually unique on what they do, meaning it's a specific industry or product. Or it could be a program administrator that has a lot of different products. Think of K2, if you've ever heard those guys. They're a program administrator with probably 20 different specialties. It could be vacant homeowners. It could be real estate investment properties. Scott, I know you do all that. So, it's very segmented. Usually, once again, almost always the program administrator has some type of variable commission rate.
Right.
So based on your performance, you better know what you're doing. If you're not doing anything, you ain't going to make no money. Once again, we'll go back on retail. You're all going to, you make a buck. If you burn up a carrier, you can probably get another carrier. It's not hard. MGA, you're always going to make a buck. If you burn up a carrier, you can probably get another carrier. But the higher up you go, you burn a carrier, the much harder it is for you to get a replacement carrier. So that's where you got to build underwriting staff. You better know what you're doing as you go up the ladder. The other avenue, which we hadn't talked about, is aggregators. With the SIAs of the world, or we've all talked about different aggregators. And that's where you get a group of agents and you work a deal with Safeco and say, hey, or pick a company, AAA, and say, I've got all these buddies, they're good agents, and I'm going to make sure they give you the best business.
Sure.
Pay me 2 points more to get everybody aggregated together. That's a tough model today. As you guys know, carriers don't like aggregators. They don't like direct appointments. You know, you don't want a broker, wholesale broker, a Safeco policy. You're going to make 2 points and touch it 16 times. So they an aggregator, it's tough business right now. Now,
It
8, 10
is.
years ago was great business to be in.
He and I just got through having a conversation about an hour ago, and somebody had brought up aggregator clusters and, you know, wanting us to talk about it. And we said exactly what you just said, basically, which is that's a tough business to be in right now.
Well, you know, one thing I would say, hey guys, we're not experts on everything. We failed a lot of stuff. One, we tried something aggregate 10 years ago, and it's an epic failure. It's just no, it doesn't work.
Right.
It's just for us, we just couldn't have worked. You know, we set up a reinsurance brokerage facility as reinsurance brokers. Didn't work. So, you know, it's just there's a time and place for everything. And we can talk about why it didn't work, but I don't want to guess on. You know, I want to talk about items that's relative to the retail shop, you know, whether it be startup, existing on, hey, you know, where's my future go? How can I maximize my retail book to, you know, can I double down on set up a wholesale or set up an MJ for state specific product specific? Does it make sense? Is that what I want to spend my time on?
Right.
Because once again, you spend time on that, takes away from retail sales.
That's
so you
right.
got to decide, you know, and I can make arguments both ways. I mean, you know, I can make arguments, you know, like our retail books, it's $100 million of premium, $12 million worth of commission income. But if we didn't do all this other stuff, we might have been a $400 or $500 million retail agency today. I just
Right.
don't know, you know. But it's just, you know, you know, from my and my brother's MO is we like different things. We just like the space, and you know, we've got ADD. I mean, so we got to do something different.
Right.
You know, we wake up. What else can we do? And
Hey,
some things flop. And you know, I can talk about the risk side. It's not all manna from heavens, guys. We've had some, and it's not well, it's been my fault. I have some dumbass shit, you know, from 2008 to 11, and I'm gonna share numbers. We lost $35 million on some programs. I just, you know, I everybody gets an ego, you know, at some point in their life, you think, I'm master of the world. I'm master of bass fishing. I'm master of insurance. And, you know, and what happens, you know, the Lord knocks you down and knocks your ass down to the ground. And that's exactly what happened to me. I'm the master of underwriting. Look at all I've done. And I wrote way too much business. It's actually long haul trucking. Way too much business, took way too much risk. And it took them 7 years to dig out that damn hole. Good lesson. There's nothing with risk, but I learned, okay, but you want to take smaller pieces of risk and maybe,
Right.
you know, have a portfolio of risk, not just double down on one segment thinking, hey, you know, I know exactly this, you know, I know exactly how to do this. I'm going to write, you know, all this. I'm smarter than everybody else. And no, you're not. You know, you're not. That's just part of it as well.
Hey, Bob, I had a question, and I think you're the man to be able to answer this for me because you understand all the moving parts of this big industry we call insurance. So, you know, more and more business today, year of our Lord 2025, is going excess and surplus, right? Yes. I mean, it seems
like
not
slowing down.
Yeah, it seems like every year more business, and I'm talking United States of America here, but more and more business seems to be creeping over to that excess and surplus side. And my agency's got a couple of some of these large wholesalers that you mentioned earlier. We got $2-3 million of business with them. And as you know, typically with those wholesalers, you get paid a little less commission. You take a little bit of a haircut. But you know, in my mind in the insurance business, anytime you've got a lot of premium with any one carrier or any one wholesale broker, the tail does start kind of wagging the dog a little bit when you get up there into the millions. Is there a way for me, because these wholesale brokers don't offer profit sharing. There is no, it's not like Travelers or Nationwide. How do you parlay having $2-3 million with one of these wholesale brokers?
How you get some revenue out of these guys? Yeah, how you squeeze them a little bit?
Right.
Yeah, I'm with you 100%. So the first thing we'll say is a lot of your agents, and I've heard on you know, on the podcast, they need to understand E&S. They need to get licensed. They need to be licensed for excess surplus lines. It's not complicated. They just understand.
And it's not going away. It's not going away.
No, it's not going away. It's getting bigger. I mean, the world is riskier today than it was yesterday.
Yep.
And that I know property, a lot of it, guys. The next thing's coming through is casualty. A lot of carriers, they've ate up a lot of the reserves. Casualty is going to be the next hard market. I'm talking about GL and some of the PL classes.
Umbrella.
Casualty is going to get tough. It's going to get tough, and all the standard markets, they've all got their models, and their model says don't write this, that, and other. Don't make no sense.
Yeah.
And so more and more businesses are going to the ENS. So first thing I can say is get your ENS license. Take the test, make sure you understand the forms you're selling. Because once again, not admitted means that carrier can be completely flexible on the forms.
Sure.
So there could be some gotchas there. So you need to, it's not rocket science. You will read the policies and make sure you understand what you're selling. That way you don't have an E&O claim where your best friend, something's not covered and you told him it's covered because you had him with Nationwide and now he's with Kinsale and something's not covered. And here you go. So, so that's the first thing I can say. Do that. Everybody needs an ENS license. It's going to get bigger market share. It ain't going to go away. That's the first thing everybody take away. Do that on your New Year resolution for 25. Get off your ass. Get it done.
Is there a monetary benefit to that with the ENS brokers?
Well, now the next thing, so answer Scott's question. Fees. So ENS side, you can legally charge fees.
Right.
The ENS wholesale charges fees. Now, some states like Florida has a limit, yada, 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 but it's pretty much free. So first thing I would do, I would tell XYZ wholesaler, I want you to put a $200 broker fee on for me on this one. $100 broker fee, $300. Now you can't be bashful. You got to know your client, and they can build it in their broker fee, so it's not a line item. They don't really see that. Right. That's not the Brad Scott broker fee.
Yeah, so let's say because then if you do it that way and you hand somebody a quote or email them a quote, first thing they're going to say is, "Why is this I Protect broker fee on here?"
Yeah,
So let's say you're working with Appalachian, or RT, wherever. Say, look, guys, I won't be able to. You guys maybe have a brokerage fee structure everything under $10,000 is $500.
Yep.
So I want to be $750. I want $250 back. And guess what? If they don't do that, call the next guy because that will get done.
Yeah.
There ain't no hair off their ass. So that's an easy way to get some extra revenue in. That's the first thing. I would recommend that you're out in a new venture contractor or a new venture restaurant, put a broker fee on. Half this stuff they lapses midterms, a pain in the ass. It's just, make a buck or don't fool with it.
Right.
You got to make a buck, so that's easy. Now you start getting in, let's say accounts, I don't know,
100,000 or higher.
No, hell no. I think you start getting $10,000 to $25,000 premium range. Ask for, hey guys, I need another point. Guys, everything is negotiable. Look at like you're buying a used car. That's what I can tell you. Everything is negotiable. If you got a good broker or a good underwriter or salesperson on the other end, they're going to get it. They're going to get, I got to make another point. You're not going to get 5 points. You're not going to get that.
One thing
at least try to squeeze in, and don't do it on a $5,000 policy. That's where you squeeze the fees in. Yeah. Now, you might say, look, I'd rather have on the $10,000 policy, I'd rather have a $500 extra broker fee because it might be hard to do both. Because say, wait, you're getting greedy here.
Yeah.
So I like the fees because all it's fully earned. A lot of times you can roll that in the finance. Sometimes the finance companies will get the down payment on the fee. So you don't get screwed on the finance companies are pretty liberal now. You work with them some, they don't have to have 100% fees and taxes up front. So that's where you start working finance companies. Hey, we have a good book where you can smooth this thing out. I need a down payment on maybe on taxes, but on the fees and inspection fees. Like I said, everything's negotiable. And now's the time because if you don't ask for it, you will not get.
Yeah.
But the easy low hanging fruit, add to the broker fees.
Yeah.
Just have the broker add your cut in. The insured don't know no difference. And you can do that today. You can do that tomorrow, and that's going to put money in your pocket.
So let me ask you a question on the surplus lines license. This is a selfish question. So we acquired an agency last year. One of the employees that came with that agency over to us was 65 years old, had 35 years of experience in insurance. And he asked me, he said, do you have a surplus lines license? I said, no. And he said, well, if you do, you can file the the taxes and stuff.
Yes, you can.
Is there a benefit to doing that versus just letting the MGA do it?
No, hell, just there ain't no money in it. I mean, just let the wholesaler do it. A lot of wholesalers don't want you to do it because they're afraid that you won't
Do it
get them
wrong or
filed.
something. Yeah.
So just let them do it. I
Yeah.
mean, it ain't, they got people on staff and it might cost them $20 or whatever internal costs. I wouldn't fool with it. There's no margin to be had there. Like some wholesales or MGAs will break out like a line item for filing fee, but it'll be like $50. So
We had
I wouldn't fool with it.
So we had a carrier.
I just wouldn't fool with it.
We had a carrier, Bob. Scott will think this is hilarious. So we had a carrier. Honestly, I can't remember which one it was. Like 3 weeks ago, that met with us, and they are doing insured self inspections now, which a lot of people are doing, right?
Yep.
So they, what they're doing is, if the insured does the inspection, they charge a $150 inspection fee. Like, if the insured does the inspection, the insured gets $150 off of their policy. They don't have to pay the inspection fee. If the agency does it for the insured, the agency gets the $150. So we left the meeting, and I looked at my director of sales and I said, "You know what I'm thinking about?" She said, "What?" I said, "I'm going to go find me a high school kid, pay him $9 an hour." You have exactly one hour.
Fly the drone around.
Exactly. You have exactly 1 hour. And that's something we've actually thought about, is starting our own inspection company, mostly because all of these people that these inspection companies contract are just absolutely god awful at their job.
Yeah, they're not good.
And it's because they're not paying them a lot. But you mentioned premium finance. Scott and I have a small equity stake in a large premium finance company. I see this post in the forums a lot where somebody will say, "Hey, how do I start my own premium finance company?" I have a friend who's in a very small town, right? Very rural, no other towns around it. And he started a premium finance company. And I told him he was brilliant because there was only like 3 other agencies in town. There's no other towns around there. If he doesn't write an account, one of these other agencies is writing it, and they're financing it through his premium finance company. I'm like, dude, you almost make more money if you don't write an account because you don't have to service it.
Just get the finance revenue.
But somebody will ask this question, "Hey, how do you start a premium finance company?" And the argument against it always is, well, just contract with a premium finance company that'll give you a take rate, 3 to 5%. So what's the point that you need to look at? If I'm making 3% override, I can't imagine the margins are that great. But what's the point that you think a retail agency should look at? Hey, when do I start my premium finance company?
Yeah, so let's talk about 2 things. First, let's do the inspection. So we had loss control company. We sold that when we sold to the MJ to Appalachians. With Appalachian Underwriters.
Okay,
it's a good business. So it's 2 things. Okay, the first thing is, if it's admitted, okay, you got to look at the fee structure in your state. Can you charge another fee? Some states you can, some states you can't. If you can't, and if you got a reasonable insurance company, you got a book of this, say, guys, use us for the inspection service versus XYZ. And they might say, "Well, I'm paying this other service $50 an inspection." You say, "Yeah, but what's quality?" They're going to say it ain't worth the crap. So that's a discussion you're going to have with the insurance carrier, that you have. A lot of these Demotech rated carriers, they're not Hartford, or they're not CNA. They'll sit down and will and deal with you. So that there's value to have a localized inspection, so where you know what you're doing. That's on the admitted side. Non-admitted side, hey, it's easy. You go to the wholesaler, but hey guys, we're going to do an inspection, and we'll because they're paying for inspection service as well. Most of the wholesalers, MJs, don't have inspection companies. They just outsource it out. Now, you got to say, okay, hey, you can do inspection, but we pay $35, and they won't care if it's worth the crap or not.
Yeah.
That's where you got to have a discussion. So it makes sense on the underwriting side. I can tell you it's not a big margin. If you're an MGA, it gets to be a bigger margin because, we did a lot of phone inspections. Your property inspections is going to be what there are. And we did a lot of text inspections. So in other words, on casualty or comp side, we would, after we wrote somebody, we would text them, hey, we just want to verify your class, your payroll. We just
Yeah.
want to we're not inspecting anything. We just want to verify you are what you told the agent you are,
Right.
and you
Yeah.
got the sales, the payroll of what you told your agent is. That's all I'm worried about. I don't care if you're wearing safety toed shoes, or I don't care. I just want to get the right class and the right rate.
Yeah.
Right.
So that's on loss control. But there's a lot of technology now. The text really works well because nobody's emails, and you get a phone call. They don't know who it is. It goes to spam. But everybody responds from text. I mean, that's the world. So I think that's a good way for non-property inspections. I know you focus on more property. I think it's a discussion to have, but you're going to have those that with the smaller carriers that will value what you provide. That's the whole thing. You got to be paid for value. Bring value, you be paid for it. If you're going to pay for it, screw it.
Mhm.
Now, premium finance comes. So let's talk about that. So we've had one for a while. We outsource the back office. We use Input One. There's costs. There's 3 or 4 folks that will run all the back office. They will charge you a flat fee, per transaction. You can provide the capital, or you bring, the banks love to give you the capital for the finance companies. If your average account size is say 10 grand and below, 5 grand below, after your cost of capital, you'll still make 10 to 12 points, even outsourcing it. And they do all the work, even if a bank's supplying the capital. So, because you got late fees, reinstatement fees, fee. So it's good margin business. Now, if you're not financing at least $1 million, don't fool with it. I mean, that in my mind, that's kind of the minimum. And if it's less than $1 million, do a deal with IPF or somebody, get a 3, 4, 5 point override, negotiate as high as override you can get and go on.
Mhm.
And even if you do a premium finance company, then what I would do, I'd still work with a third party for the big stuff where the rates get competitive, and I'd keep the small stuff for myself.
Almost like a bookie.
Yeah,
The bookies always pass the big bets on to the bigger bookies, and they keep the small
you
ones.
get 10, 15 grand or above, and going 12% rate, screw it. Let them handle that. I want the 26% rate.
Yeah.
And really, what you guys need to do, you guys all together, do a joint venture for all your listeners and members, and outsource the back office to, Input One guys do a great job. They run $5 billion worth of premium finance through different models. Do a great job. I'll give you the folks' name, but that's a slam dunk for the group because you guys can get buying power there. Now, I've always done financing that we're the agent or MGA for. I've never took third party because I never trust will they cancel policy in time, and there's going to be some thievery going on. So a lot of folks do that. I've just never done that. I've always done the stuff that I can control the cancellation date, and I know people ain't making up finance contracts. That's just me.
Hey, Bob, I got a question for you. Where's the white space in the insurance industry right now?
Yeah, now define white space. With opportunities or what?
Right. Correct.
Well, I think we touched on this. E&S that market's going to get bigger. If you don't understand, if you don't have your surplus lines license and understand the E&S market, the type of accounts you go out is going to be dwindling very quickly. It's going to be very quickly, and your appetite's going to be very, very narrow. So if you're a traditional agent, so I'm only going to sell admitted, blah, 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 that's going away. It's just like 10 years ago, folks would say on homeowners, I'm not selling Demotech. They got to be AM Best A. Yeah, okay, well, those days are gone. So, because now you took the time to understand the Demotech rate, okay, well, that's legit. It's admitted. So you took the time to invest. You got to do the same thing for the non-admitted side. So the first thing I'd say is you got to get deep in that. And then after that, if I'm a retail agent, like I said, the premium finance, some money there, get some broker fees. If you're right E&S business, if you don't, okay, you don't. Specialize. You guys always talk about. You got to bring value to the customer. At the end of the day, if you have value, it's paid. And I'm going to mention one other thing which you don't need to worry about, and everybody talks about is B2C, direct to consumer. We've been exposed to this from our end for the past 10, 12 years. We most of the direct to consumer markets I partnered up with 10 years ago when they came out because I knew they would fail and they need distribution partners. And guys, it's 1% of the market. I don't know. Will it be a factor in our kids' lifetime? Yes. But it ain't gonna be ours or it ain't gonna be our kids because it's growing so small. Because if you look at we did mostly on commercial lines when that kind of jumped in, let's say 10 years ago. And their cost for Google ads and advertising weighed out so much more than just paying commission.
Right. Well, it's like,
I mean, it's just crazy. It's crazy.
I looked at Lemonade's numbers 2023, and these are not exact numbers, but I did say it on a previous podcast. So Lemonade likes to say that they saved the consumer money by not paying the agent 15%. Okay. The amount of
but what's the actual cost on what paying Google?
Right.
Yeah, I'm paying them 30%
so they,
or whatever.
They spent, I think the number was they spent $30 million on advertising. And if they would have paid the agents, it would have been like $8 million or so. It was something like crazy like that. Now, the counter argument to that from the Lemonade folks was, well, but that advertising is a one-time cost. The 15% is every year. True.
Understood.
True. However, when you're so it's like I had a regional VP from Allstate in my office 4 years ago, and she said, "We are firmly committed to the independent channel." I said, "Can I guess why?" She said, "Sure." I said, "If I go as a customer in the average Allstate agent's office and all they have to offer is Allstate, they are going to try and fit me in a box to insure me. If somebody comes to me and they don't fit with Allstate, I'm not going to put them with Allstate." And she said, "You're exactly right. That leads to lower loss ratios, better retention, happier clients." And so that would be my counter argument to their counter arguments. Like, okay, yeah, it's over multiple years, but you're getting a better client, a more targeted fit client. But then also you're spending that much on advertising every year. So it's like,
well, and you touched on a bunch of things there. So let me first thing to say is captive agencies. If I was captive, I'd be getting out. I'd figure out how to get the hell out as soon as I could, because that's just not. You're going to see a lot of captive companies they're having to release the agencies because their appetite is so narrow, and they have to. That's the first thing. So that's my opinion on that. I think at the time they served a purpose, but that purpose is gone by the wayside. My opinion. Direct to consumer. Who do you think of? Geico. Think of Geico. Geico. I was talking. We do a lot of business with Berkshire Group. A lot of business. Well, I say we did when I was at Appalachian. So not they, but I'm talking about hundreds of millions of dollars. I mean, a bunch of business. And Geico. It took them. They started in the 50s. I don't know, 60s. It took them 40 years. I mean, the burn rate was hidden within the Berkshire mothership.
And guess what they're doing now? Guess what they're doing now? Yeah. Appointing independent agents.
Export agents, yeah, Florida, yeah. And they're not. These are smart dudes.
They've hired
not
like
doing it
200 employees from Progressive's independent division.
And you talk about Lemonade. Once again, the great, brilliant guys, and I promise I'm not trying to knock a competitor out.
For sure,
but they don't make money. And if you had the Berkshire war chest behind you, you could ride that up for the next 20 years and spend $2 billion. I don't know what the number is. Spend a lot of money.
I think Geico spends about $2 billion in advertising.
And think about this, and I'm not knocking anybody. I'm just using some common sense stuff. Look at their, report from maybe first, second quarter last year. They did a deal to raise money by pre-selling their future commissions. Just look at that. So what they did was they did a deal to, private, one of the private equity groups or, one of the money folks. Said, okay, guys, I want you to prepay me on what the commission would be, and our lifespan of the customer will be 4 years. So you go ahead and cut me a check for the 4 years worth of commission up front so I can book that revenue. Now, does that sound?
Sounds like robbing Peter to pay Paul.
It sounds jackass to me. Now, I'm just a dumb insurance guy. I'm not a tech guy. So maybe there's some kind of magical tech dust you can split up, spin all that. But it'd be like you on retail side saying, Safeco, hey guys, go ahead and pay me the next 4 years worth of commissions up front. And then, I'll give you an 8% coupon. To my opinion, and I don't want to get sued by anybody, it's active desperation to try to prop up the numbers. Look at Hippo. What they do, they sold First Connect. You saw that a couple quarters ago.
Sounds like a payday loan. That's what it sounds like.
First Connect was a digital wholesaler. Margins was good, successful. They're having to prop up. All this technology is great, but it comes back. You got to make an underwriting profit. If you can't make an underwriting profit, then it's not going to work. Look at Root. They finally showed they can make an underwriting profit, and the stock's been rewarded. Now, if they dug a big ass hole, it's going to take them a while to dig out of it. But that's why their stock's rebranded. Look at Porch. Porch is converted to a reciprocal, and we can talk about that another show sometime. But the reciprocal is a way that the policyholders support the surplus, and it generates guaranteed fee income. That's why Porch went from the brink of disaster to where they got a chance of making it. So it's just, the InsurTech balance sheets folks that said, we know how to operate an insurance company better than the Travelers or whoever, because we know all this technology stuff. And I'm sure you can make some minor improvements, but you can't put the world on its head. I mean, Next is the same thing. Not the nice folks done a lot of business with Next, but there's a reason why they pulled out a lot of lines of business a couple 3 years ago, just because they.
I think they pulled out auto last year.
They missed it.
I think.
Yeah, auto. I mean, they just it's just it's you can do that, but you got to do it at a smaller scale, or you have to have investors that understand, hey, this is not a quick flip. I'm in this for the 20-year haul. There's investors out there like a Berkshire that they understand that. But if you're XYZ PE firm that needs to flip investment over 3 to 5 years,
yeah,
probably not the right investor to partner with. I mean, that's just me. That's some high finance way above my head. But common sense just tells you it ain't gonna work out so hot. And that's why you're not seeing any new ones formed. And that's why it seems, once you see they're dropping like flies, because nobody wants to keep on, not just P, but much less not even VC. And not even balance sheets. Nobody wants to say, yeah, burn $5 million. Okay, you're talking about burning? What the hell are you talking about? You're going to burn $5 million and that's a success? Are you crazy? I mean, the numbers are so big. It's about our burn rate. My head explodes. Mm-hmm. I mean, burn rate? I mean, are you listening to what you're saying? Just ridiculousness.
Hey, Bob, I want to add something to this conversation for a second. So in 2010, 2012, they started talking about the death of the independent and the insurance retail independent agent. But here's what I can't seem to understand. Over the past 3 years, really probably the past 5, but especially the past 3 years, all of these carriers, it appears to me, and I probably read more carrier contracts, i.e. insurance policies, than most of the people out there, are having their staff attorneys walk away from the ISO standard policy form that was been around since 1973, and they're creating these modified policy forms where you need about a master's degree in insurance, because hanging out here to the side are all these endorsements that you can add back in. You got to have all this. My question to all these carriers is, you keep talking about direct to consumer, but what you've done in effect is made it almost impossible for the guy and girl out there in the big bad world that wants to jump on your website and get a homeowner's policy, hell, for that matter, even maybe even an auto policy, to do it correctly themselves without going to college to get a degree to figure out how to do this. Now, I will say, if you're selling renter's insurance online and all you got to do is put in your damn address and okay, I want 25, whatever the number is.
Yeah,
maybe that works. Maybe that works. But I don't see, if you're going to continue down this road of modified policy forms and walking away from the ISO standard, how you can expect, Ricky Sutton down there on 867 Pine Ridge Road to jump on the internet and write his own homeowner's policy.
Well, so I got two thoughts. First, talk about personal, then we'll talk about commercial.
Sure.
So on personal lines, the carriers admitted, the regulated, they have to submit forms to the various state regulations, and the regulators push back quite a bit. Yep. They really do. So, but like the roof limitations, some stuff, the pressure so much on homeowners, the regulators are having to approve some of this stuff.
Right.
That they got no choice. Okay.
Because there's so
Now,
many
not
changes
admitted,
to those
it's Wild Wild
policies.
West.
Yeah.
Okay, it's Wild
right.
Wild West or not admitted.
That's
So
right.
so there are some protections on admitted where it can't get too far, and if Allstate sees that Liberty's got this endorsement approved for the age roof limitation, they're going to copy that because they say, "Oh, it's been approved,"
right?
So we can kind of me too that endorsement on there. Okay,
and that takes a little bit of the risk off of Allstate because now you got
everybody's doing the same
roof
thing.
surface limitation endorsement. Yeah.
And everybody's trying to do it on homeowners. I ain't seen anything on personal auto. I don't see,
auto's been about the same. Well, you're right.
Yeah. Now, and I don't know the stats. I've heard this from different folks. Direct-to-consumer personal lines, I mean, it's flat now. It's not growing anymore.
Yeah.
I mean, they've got this segment. Actually, last thing I saw last year was it shrinking a little bit.
Yeah.
So, so from personal lines, folks want a deal. It's like if you guys run the lotto and had $100 million, are you going to have E-Trade handle your investments, or are you going to go to your local Edward Jones or Merrill Lynch office to make sure you're protected?
Right.
I mean, what morons are going to go in E-Trade? I'm going to let somebody else. No, of course, you want a professional to do it. So to me, insurance is the same thing. So if you provide value today, to the insured, then so be it. Now, if you got a 21-year-old buying auto insurance every 6 months, well, at some point they're going to get married. They're going to have a little bit of sense about them.
Sure.
Say, I need to have somebody that I know if I have auto accident or a billing question. I don't have to go online, do a chat box. I can pick up the phone and call somebody. So I think that bubble's top now starting to come down because folks see the value. I think, like you guys said before, direct consumer saw, hey, it's cheaper for us to use agents than it's the direct consumer anyway.
Right.
And that's where you see the Geico's of the world. I mean, who would guess Geico? You'd asked me 3 years ago, I would never guess they're working with independent agents. It's crazy.
Right.
Now I think part of that is because Progressive surpassed them, I think, is a larger market share than Geico last year. So kid you not, there's some ego going on there too.
Yes.
I'm sure. Now commercial lines, now that's another one. It's such a minuscule piece of folks that buy direct to consumer on commercial lines because the insured, they don't know what they need. And this is the last thing they want to do. They don't want to fool with this.
No.
They're not like buying a new car. They're not excited about this. It's so much easier for them to call an agent. Hey, I'm opening up a pizzeria, whatever it is. Here's what my lease says I got to carry. Can you fix me up?
Yep.
Explain to me what holes I've got, what's covered.
That's right.
Direct to consumer is, you see all these ads of folks are dog walkers or cookie makers buying direct. Okay, that's just, sounds good. Yeah. But it ain't going to move the needle in our lifetime whatsoever. And there's difference in forms. It's just too complex of a transaction. That, in our lifetimes, you guys younger than me, but collectively, that's never going to be an issue for us.
Right.
It's just not.
Right. No, that's right. Man, I appreciate you being on the show. I got to shut this thing down. Hey,
no worries,
Bob. Anytime, if I can ever help you, please let me know. I got your number. I may give you a call. I want to bounce some things off of you one day.
Hey, you guys, call me anytime. I'm here to help. I appreciate what you guys do, and I want to support it any way I can.
I appreciate you, man. Thank you. As I end every episode, rewards come from action, not discussion. Get your ass out from behind that desk today. Go out into the big bad world. Make money for your wife, for your husband, for your kids' college fund, for your parents and in-laws like mine that are struggling out there. Go make money for them. Write good business for the agencies that you represent, and write good business for the companies that you represent. Bradley Flowers, I love you.
Thanks, buddy. Thanks, Bob.
Been a good day.
Thanks, guys.
Stay on 1 second for me.
Guys, you were listening to the Insurance Guys podcast, and we love each one of you. Thank you so much for being a part of our family. We'll see you back here real soon. Take care.